Okay, welcome everybody to our Business Financial Planning University class. Let me share my screen real quick, so bear with me. It's my first time doing this in Teams. Okay, can you all see my screen?
Yes, ma'am.
Great. Well, welcome. Happy to have everybody here. Today we're just going to discuss some business basics, a little bit of budgeting, and some of the available resources that you have both inside PJ Morgan and outside the company. And we also have Adam Austin here today. He is a CPA and the tax manager at Lutz. He is going to help me with the business basics. And then after that, he'll be happy to answer any questions that you might have for a CPA. So I will go ahead and turn it over to him to begin.
All right, thanks, Tara, and thanks everybody for letting me join in today and giving you kind of a little overview of, I just put together a list of topics that I think are probably relevant for most of you operating in that real estate, the brokerage and sales space. We deal with a lot of people who are operating in that space, and it can be, rules change frequently. There's a lot to stay on top of, but it's important stuff that can, really be beneficial to you if you're keeping these things top of mind in running your business. So,
sweet.
The first set of rules I wanted to familiarize everybody with, if you're not already familiar with those, is what's called the real estate professional rules. These are important for, yourselves being, brokers and salespeople in the real estate profession, as well as, I think it's important information to be familiar with as you're talking to prospective buyers and things like that, because these rules can really allow somebody to take advantage of their investment opportunities to reduce, the tax bill that they're paying every year, which is always something people like to, try to use those rules to their advantage. So to give you some background on these real estate professional rules, the IRS says that by default, any real estate rental activity is considered a passive activity. And why that's important is the classifications of passive versus non-passive income in the mind of the IRS. Any sources of passive income that you have, or I should say passive loss, cannot be used to offset non-passive income. So if you're an employee who's receiving a W-2, receiving a salary from your employer, that is non-passive income. Or if you're a business owner who is running your business every single day, that is your full-time job, that's non-passive income. Any loss that you have from your rental activities outside of that can't be used to offset that non-passive source of income, unless there's other ways you could do it, but the main one is to qualify as a real estate professional. And so, if you're somebody who's receiving a W-2 that shows $100,000 of taxable salary and you have a rental property with a $10,000 loss, unless you qualify as a real estate professional, you're going to be paying tax on $100,000 of income. Whereas if you qualify as a real estate professional, you'll only be paying tax on $90,000. So in order to qualify yourself as a real estate professional, then each year you have to be performing more than half of your services in trades or businesses that are real property trades or businesses, which the IRS considers, real estate development, construction, rental, management, brokerage services. Those all qualify as real property trades or businesses, where likely, if that is your full-time day-to-day job, you are a real estate professional. I mean, a lot of times there's some gray area, but most of the time it's pretty black and white when somebody does or does not qualify as a real estate professional. So you have to be doing more than half of your full-time services in that real estate realm, and you have to be doing at least 750 hours a year. So we have a lot of people who retire from their full-time job as a doctor or whatever it is they're doing, and in retirement they kind of dump their interest in their rental activities, and they spend 750 hours a year working on those rental activities, whether it be coordinating maintenance on those, or doing their own books and records. They then in retirement qualify as a real estate professional, and it can set them up in a pretty favorable position from a tax perspective. So the other important decision I think a lot of people need to look at when they have their own rental activities, or for those of you who are receiving your compensation in the form of being paid on what we call being paid on a 1099 versus being paid on a W-2. So you're being paid as an independent contractor. The way you report that income and how you account for it and structure your business can have all sorts of different impacts, not just in tax, but in lots of different ways. And one of the biggest decisions I think people need to make off the bat is the type of entity that they're going to classify themselves as. And there's different entity types from a legal perspective versus from a tax perspective. So when we're talking about legal entities, you're going to either file records with the Secretary of State to be considered a corporation, or you're going to operate as a sole proprietorship, or you're going to, meaning just as yourself, or you're going to file records with the Secretary of State to be an LLC, a limited liability company with the from a legal perspective. But in the tax world, we have what are called S corporations or C corporations. Then you have partnerships and you have sole proprietorships, which I mentioned. So an entity that is legally formed as an LLC with the Secretary of State can elect to be taxed either as an individual, if it's just a single owner of that LLC. It can elect to be taxed as a partnership if you've got 2 or more owners of the LLC, or it can elect to be taxed as an S corporation. And same thing with, an entity that is legally formed as a corporation with the state. It can elect to be taxed as either an S corporation or a C corporation. And these different, tax terminology entities I'm throwing around, I'm sure a lot of you are familiar with, but essentially the, anything that's being taxed as a partnership or as an S corporation, the way it works is that entity files its own tax return, and then the profit is allocated out to the owners in some manner, either based on ownership or on an agreed upon way. And each individual pays tax on their share of the profits every year. So if you've got a 2-person partnership that makes $100,000 net income, each partner is probably, assuming 50-50 ownership, going to pay tax on $50,000 of income from that partnership. And those decisions from a legal perspective can obviously be important, but the area that I'm interested in my day-to-day job is the tax implications of those different entity choices. Typically, the biggest impact that it has is whether or not you're paying self-employment tax on that income. So if you're organized as an LLC or as a partnership, from a tax perspective, you're likely paying self-employment tax on the income that you're generating from this activity. Whereas if you're organized as an S corporation, there's all sorts of caveats to it, just like everything with tax, but a lot of times it affords you the opportunity to take money out of the business in the form of a non-taxable distribution, or you could think of it as a dividend, and you don't end up paying any self-employment tax on any of that income. The downside of these different tax entity structures is there's some additional compliance costs with them. So once you elect to be taxed as a partnership or as an S corporation, the entity is gonna have to file its own tax return, which they're pretty complicated. You're probably gonna have to pay somebody to do that, and that obviously costs money. If you're an S corporation, you're going to be paying yourself a salary out of that entity. And so you're going to have payroll tax returns to file, and payroll taxes to withhold, and those types of things. So it just creates some additional burden on the just compliance, doing the things the government says you have to do on these things. So typically my kind of rule of thumb with this is once you're making over on average every year about $100,000 net income, so the revenue you're generating minus your expenses, once each year you're hitting about $100,000, it becomes worth it to really consider if you want to make the change to being taxed as an S corporation or as a partnership, because you'll incur those additional burdens of the additional compliance costs that I mentioned, but probably those additional compliance costs would be offset by some tax savings. So that's something that, I think really requires sitting down and evaluating with somebody who's qualified to evaluate those things for you to help make those decisions. So those are kind of the big things from an entity perspective. When people are getting started out, or when we are talking to somebody for the first time, we always recommend using a completely separate bank account and credit card for your business operations versus commingling those funds with your personal accounts. You don't want to be paying for your business expenses out of your personal checking account, or putting those on your personal credit card for lots of different reasons. But certainly number one has to be that it's just so much easier to help yourself keep good records if all you need to do at the end of every year is pull up 12 months worth of bank statements, and that effectively is your financial statements for the year. I mean, cash comes in, cash goes out, it's income or it's expense. And it's just so much easier to keep track of things that way versus having to identify business expenses and income out of your personal bank account. The IRS also, has if you're commingling these things with your personal funds, whether it be credit card or a bank statement, the IRS is always going to, in the event of an audit, the IRS is always going to try to come back and, contest certain expenses and say that they were actually personal expenses instead of being business. So it's always a good idea to get those things set up completely separately. It just makes, I think it alleviates a lot of headaches if you're just keeping business completely separate from personal. So that's also kind of a good segue into, thinking about the types of expenses that you can be running through your business accounts. The IRS is always going to say that any expenses that you're deducting to offset your taxable, revenue, they have to be ordinary and necessary, essentially meaning, it's not outside of the norm of what a normal business operating in your, in your case, the real estate arena is going to be deducting. So for most people operating in the real estate realm, some big ones are you're gonna probably have a lot of mileage, I would assume. You've probably got your main office location where driving to your main office location first thing in the morning is going to be considered commuting. It's non-deductible. But then if you're leaving there and you're driving out to meet a prospective client, or you're taking somebody out to lunch, the mileage to and from those secondary work locations every day is deductible. And you really ought to be keeping very good records of that type of thing too, to support whatever you're deducting. And the thing I always recommend is they have great apps for the iPhone and Android that you get in the car, you hit a button, it starts keeping track of your miles for you. You get to your destination, you hit the button again, and at the end of the year you can just print a summary of your miles for the year, and it just makes life so much easier. And when you're dealing with your car, you have the choice to either deduct your actual expenses or take a standard mileage. So, I think the rate for 2021 is 56.5 or 57.5 cents per mile. You can do that, or you can deduct the actual cost that you incur, filling up with gas, oil changes, car washes, all that good stuff. Always want to keep good records of meals. When you're taking prospective buyers or sellers or potential clients, coworkers out to lunch, always keep that receipt. Make a note on the back of the receipt of who you were with, what the purpose of the lunch or dinner or drinks or whatever was, and the IRS will allow that as a deduction. Unfortunately, it's probably going to be limited to 50% of the cost of the meal. They say it's part business, part personal. Everyone's got to eat, but every little bit helps. Gifts that you give to clients are going to be limited to $25 per person, but given little trinkets that have a marketing material on them or whatever are always a great way to get your name out there and take a deduction. The use of your home provides a lot of opportunities. You can deduct, $5 per square foot of your home office, or you can allocate, you can say I live in a 2,000 square foot house. My office is 200 square feet. So 10% of the expenses of my house every year can be deducted to offset your income. Then there's just all sorts of other things you incur all the time, continuing education expenses, marketing materials, developing and maintaining a website, your personal cell phone bill. I mean, I would say this, the people that we work with vary in the range of how aggressive they want to be on expenses versus how conservative they want to be. But being self-employed and being paid on a 1099 allows you a lot of opportunity to, really think about the things that you're deducting to offset your income and minimize your tax burden that, those of us who are being paid as a W-2 employee don't necessarily have those opportunities. So it's definitely something that is worth the time and effort to, talk to somebody about and really brainstorm those types of things that could, you're probably already paying them, just report them on your tax return to alleviate your tax burden a little bit. That said, on the slide there, I have what the IRS refers to as the presumption of profit. We have people who want to get extremely aggressive with their deductions every year, so much so that they're showing a loss every single year, and that just can't happen. The IRS will come back and say, this isn't a business, this is a hobby. You're showing a loss every year, and so the expenses are non-deductible. So you want to make sure that you're showing a profit at least every 3 out of 5 years, which when it's your full-time job, that's never going to be a problem. You're never going to have enough expenses to offset the income every single year, but just something to be aware of. As sort of a standard practice, we always recommend that, like I said, keeping your business banking and credit card accounts separate from your personal is always a great idea. File those statements somewhere, file the receipts for your expenses, any 1099s that you receive to report income, keep those in a file somewhere nice and organized, and probably want to hang on to those for at least 3 years. I would say best practice is more like 5 to 7 years. So definitely want to keep those safe in the event you're ever audited, whether that be by the state or the IRS or whoever. It's always a good idea to make sure you've got those in good working order. And I think the last thing I wanted to kind of point out again when you're being paid as a contractor on a 1099, and so you are considered self-employed, it allows you some really, really good opportunities to push a lot of money into retirement that most people don't have. So the average Joe who's being paid on a W-2 is going to be, a lot of people talk about your Roth IRA or your traditional IRA. Those allow either $6,000 or $7,000 per year if you're above age 55 that you can dump into your traditional or Roth IRA, individual retirement account. But people who are self-employed typically have a bunch of other options. Self-employed 401ks are one. The most common one we see is what's called a SEP IRA. That allows a person to, under the right circumstances, you can contribute up to $58,000 in 2021 to your retirement account. It's typically kind of an actuarial calculation that's based on 20% of your self-employment income, generally speaking. So you really have to be making a substantial amount of self-employment income to hit that limit. But even somebody who's making $100,000 net income from self-employment should be able to contribute $20,000 or so into a SEP IRA. Just moving that money from your personal checking account, putting it into retirement, and being able to take a deduction that offsets that self-employment tax, which I meant to mention earlier is something like 12% or so. So anything you can do to offset that self-employment income and save on that self-employment tax is huge. And retirement plans are normally the first thing I recommend somebody look into doing if they're not already doing that, because the savings can be enormous and it's just good financial planning for yourself for the future. So that's all I wanted to cover today. I think those are kind of the high points, and I wanted to keep it brief, leave any time for questions if anybody has any. The slide that is shown there has my contact information down on the bottom. Like Tira said, I'm a tax manager here at Lutz. We're located on about 136th and Dodge-ish, right behind Stokes, across Dodge Street from Boys Town. So some of you may have seen our sign driving down Dodge Street, but we've got a handful of people in the office here who work very heavily in the real estate arena. We're well versed in it, and if you ever have any questions or want to talk about your personal situation, we're obviously more than happy to do that with you. So that's all I had. If anybody has any questions, I'm happy to answer those.
Adam, just a couple questions on the passive income that you talked about from the real estate investment side. First, the losses for that activity could, in theory, still offset any other passive income, such as interest, stock, trade.
Right.
Okay.
Yep. So you look at the two buckets separately. That's a good way to put it. You look at all of your passive activities and all of your non-passive activities. And yeah, if you have other sources of passive income, those passive losses can offset those. So if you have one rental activity that shows a profit, one shows a loss, you can net those two together if they're considered passive.
Perfect. And then if you do have more losses, what's the carry forward look like on that now? Are you allowed to, and how many years?
Those will carry forward indefinitely, generally until you dispose of the activity. So we see it all the time that, there's also a special deduction of up to $25,000 for residential real estate for people who are making under, I think the limit is $100,000 for a married couple. But we have a lot of people who are high income who have rental properties that are showing a loss every year. Which I also meant to mention, you can cash flow these rental activities, but show a loss on your tax return every year because you're taking a deduction for the interest on your mortgage, depreciation, these types of things that are, depreciation is a non-cash expense. So a lot of times these these rental activities will show a loss for years and years and years, and the losses aren't used to offset your income, but they carry forward forever until the day you dispose of that activity, and then all of those losses hit at once. So that's generally the way we see it happen.
Thank you.
Did anybody else have a question for Adam?
Tira, I just wanted to say that was can you hear me?
Yep.
That was can you hear?
You're cutting in and out.
Sorry. I wanted to say that was a fantastic presentation. That was very succinct. That was really good.
Thank you. I appreciate it. I told Tira this morning, you could turn this into a 2-hour discussion, or I was trying to keep it to 15, 20 minutes, but I appreciate that. But certainly, like I said, if anybody wants to elaborate or talk about any specific situation that they've run into, would be more than happy to discuss those things further with anybody.
Adam, before we let you go, is there anything maybe that we haven't discussed so far that an agent could benefit from working with the CPA from?
I think having, even if you're working with one now, when we initially start working with somebody, it just always helps to have a second set of eyes on things. I mean, I do it with friends of mine who are, have their own small businesses, and we all know that, stuff can be just kind of cumbersome. I mean, you're worried about running your day-to-day business. You need to let somebody else worry about, the tax considerations and things like that. But I think an hour-long conversation is always worth the investment of your time, because there's a lot of brainstorming that can come out of that, and where you say, are you doing this? Have you considered, these options? Like I said, typically when I start working with a self-employed person for the first time, the retirement plan options are the very first place that I go to, because it's, a great opportunity to just set you up to build your net worth for life that a lot of people don't even realize as an opportunity, and don't realize, how beneficial those things can be by the time you factor in, offsetting the self-employment tax and those types of things. So, I think I covered the most common things that we run into with self-employed people. But like I said, I think even just having a one-on-one conversation with somebody for half hour to an hour, over lunch, is always going to result in probably, half a dozen ideas that somebody could take back and evaluate their business and implement some of those ideas that, like I said earlier, you're probably already doing, just need to be reporting those things properly to, minimize your tax burden every year.
Great. Well, thank you, Adam. We really appreciate you being able to jump on today.
My pleasure.
And
Thank you all for listening.
if anybody wants to reach out to Adam in the future, again, his information is here on this screen, or feel free to let me know and I can pass it along as well.
Okay. Thanks, Tira. Thanks, everybody.
Thanks, Adam. I wanted to spend just a minute talking about filling out your W-9. If you haven't had to do this before, you're going to be asked when you start receiving commissions from whomever is paying those commissions. So our agents are probably getting asked by Lauren when they start, or by me if they've made a change. And just some basics to go through. Line 1 should always be your legal name. If you're sole proprietor, this is going to be your name, or it's going to be the name on your tax return. So if you're a partnership or you are an LLC and you're using a pass-through to your individual tax return, this will be your name. Line 2 is where you would put your DBA, your doing business as name. In section 3, you want to pick your entity type. And one thing people tend to miss is if you select that you're an LLC, you have to also designate what your tax classification is. So on that little line next to it, you have to indicate if you are being taxed as a C Corp, an S Corp, or a partnership. So just a couple little tips to help you fill that out correctly. And then of course your address, city, state. 7 is always optional if you are giving it to a specific company and they've asked you for an identifying account number, you can fill that in there. And then in part 1, you will have your social security number or your EIN number. And don't forget to sign down in part 2. And please feel free to reach out if you ever need help filling out a W-9. I'm more than happy to do that. So I'm going to jump over to the budgeting section now. So obviously, you know that your income less your expenses and your taxes get you to your profit. Just a few things to keep in mind when you are preparing your budget. You want to keep your business and your personal budget separate. A good reason to do this is tax implications, like Adam said, especially with your bank accounts. An important reason is that as a business owner, you can deduct business-related expenses, but to claim these, you have to have all your supporting documentation, as Adam said. And if you're audited, they're going to look very closely, line by line, at all your expenses. And if you have a separate bank account, there is less of a chance that they're going to try and pull in any of your personal expenses. Also keep in mind, how much do you plan to earn and how much do you plan to spend in this next year? Susan has done a budget or a planning meeting back in December to help you with your business plan. So that's a great way to have figured out kind of what these things look like, how much you plan to earn, but now we have to sit down and decide how much you need to spend to get to that number. You want to always use your previous year's performance. So you want to have your financials available, your bank statements available, so you can dig through your income and your expenses for the previous year. And when you are budgeting, I tend to recommend you budget conservatively, which means when you're looking at your expenses, you'll probably want to look a little on the higher end. And when you're looking on your income, maybe guess a little towards the lower end of what you think it could be. When you budget aggressively, there is less a chance of you hitting those numbers. So if you think your expenses are going to be super low and your income is going to be super high, that might not necessarily be realistic. And it's always a great idea to have an emergency fund. As you all know, real estate goes through its cycles. And sometimes you don't know what's going to happen from month to month or year to year, especially when something like COVID hits. A good rule of thumb is 6 to 12 months of expenses in an emergency fund. Now, if you have a separate income stream coming in, you might not need this much, but it's always beneficial to have, especially if you decide to take some time off or you just need to step away from your business for a little while. Take a look at expenses next. It's beneficial to look at expenses first when you are reviewing your prior financial statements. Your income is uncertain, so starting with your expenses lets you know how much you need to make to cover your needs. I like to start with your personal expenses because these are your essential things that you're going to need for your personal life, regardless of the state of your business. Even if you have multiple sources of income, maybe a spouse's income or another job, for example. You will still need to know how much your business needs to contribute to your personal expenses to be able to cover those. And once you have a handle on your personal expenses, you can move on to your business expenses. And I did just a brief budget. This is actually a budget that I've used in the past to track my personal expenses, and I tweaked it a little bit to fit this type of a scenario. So I took all of my expenses for the year and I broke it out by category, and you can see at the end I have what's called sinking funds, which are your variable expenses. So those aren't going to hit every month. I just like to say, no, I'm going to spend $1,200 in the next year, most likely on personal care items. So I'm going to set aside $100 a month to take care of each of those. So once I know what all of my expenses are going to be for the year, even those variable ones, then I can decide how much income I need to bring in for my business to cover my personal expenses. Then you'll want to cover your business expenses. These can be your office space, your phone. Adam listed a bunch of expenses that you can use. Have a little star in here for payroll. It's a great idea to pay yourself on a consistent basis. That way, you know how much you're going to need for your personal expenses on your personal side. If you're paying yourself a set amount each month, then you're covering that easily and you won't be as susceptible to when commissions are coming in or when they're not. And then don't forget to include your taxes as part of your business expenses. Another great way to do this is to have a budget tracking app or a spreadsheet that you can use to carry over from year to year. Talk a little bit more about some apps as we get through the presentation. Just make sure you're always considering both your fixed and your variable expenses and pay yourself. After you've reviewed your previous year expenses, this is the time to decide what changes need to be made for the upcoming year. Your variable expenses are a great place to start if you need to make cuts for your expenses. Evaluate the necessity or if you could find the same service or product at a cheaper cost elsewhere. And try not to waste your money on the small things. It's very easy to make a bunch of small purchases and not keep track of them in your budget, but those really add up over time and you will have suddenly blown through a chunk of your budget and not have realized it. And then don't forget to also plan for large expenditures. Maybe those only hit once a year or every couple of years, but keep those in mind and when those are coming. You also want to make sure you're tracking your ROI on these expenses. Make sure that if you are spending money, it's generating income. We all know the adage, you have to spend money to make money. And if your expense isn't doing its job and bringing in additional income or additional leads, then it's probably not worth it. So make sure you are spending your money intentionally by making strategic decisions. Marketing is obviously a big part of your budget. That's how you're going to get leads, how you're going to bring in clients. So make sure you are setting goals for your marketing campaign and you know what those goals are, and then track if any marketing is helping you reach those goals. If you find that a project isn't, then go ahead and make adjustments. Don't be scared to make adjustments throughout the year. It's also a great idea to plan your marketing ahead of time. So at the beginning of the year, you can plan for a monthly marketing or quarterly marketing and just be prepared for those costs in advance. Back to your budget. If your expenses are high, you need to figure out where you can make reasonable cuts. And if cuts can't be justified, don't make them. Keep your budget realistic. Just because the expenses seem high doesn't mean that they won't happen. So you want to make sure you know what's coming down the line. And you want to review your budget regularly and stay accountable to it. And don't forget to use any resources that you have available to help with your budget, such as a tracking app or anything like that. Here's a little sample of a business budget that I put together. Again, I have my commissions, my other sources of income on the left, but then here's what I thought that those expenses could look like throughout the year. On this one, I chose to not necessarily quantify it and divide it by 12. I chose to look and to see where Maybe I plan on doing signs in March and June. So I put those expenses where I thought they would go. And then I also, under payroll, I paid myself what I needed to use for the year. And then I treat this a little bit like a bank account. At the top right, I put what the balance I had, what my profit from the previous year was, and then went month by month down, taking account of my income and my expenses. And when I got to the bottom, I had a total of $12,680 left of profit after I paid myself, of course, that I can use to invest, or I can spend, or I can just save it as part of the business. Taxes are a huge part of your expenses, so make sure that you are using them when you are calculating your profitability. Make sure you're planning for your taxes ahead of time. Like Adam said, keep track of your mileage. You want to have a log of your dates, distance, locations, and the business purpose in case those are ever audited. And just a few things you can ask your CPA about if you're using one are home office deductions, depreciation on any capitalized assets that you might have. And keep track of your records. Use a bookkeeping system, track your expenses, keep your receipts. The more documentation you have to support your business expense, the better. Every little bit will help. You can also put your taxes into a savings account. You should save approximately 25 to 30% of each of your commissions to put towards taxes. If you can put these into a savings account, that money is going to work for you. You should also consider paying your taxes on a quarterly basis. And it wouldn't hurt to have a mid-year meeting with your CPA to make sure you're on the same page, see if they have any suggestions. And then again, just keep your records in good order. Next, on to income. Make sure you are setting an achievable goal based on your previous years. You should have created a plan to achieve those goals. Like I said, Susan in December had discussed business planning your goals, and then she will have another session this coming December for that if you want to jump into another university class for that. You always want to make sure you have a positive cash flow during the year. Don't suddenly want to be having to use credit if you don't need to. And then, as I had said earlier, pay yourself a monthly wage and reinvest the rest into your business. And you also want to consider all sources of income. And keep your income expectations realistic. You want it to be difficult enough that you have to work for it, but not crazy enough that you went from selling 20 houses this year to 100 houses next year. Here's just a few sources of income. Obviously, your transactions. You can invest in rentals, flip properties, become an appraiser, an inspector. There's a ton of different ways. Use any assets that you have personally to your benefit and make money from them. There's a few additional sources of income that you can actually get right here in the company. If you bring in an HOA management referral, you would get 20% of that monthly fee for the first year and 10% in following years. Residential management referrals, same thing, 20% in the first year and 10% in following years. If you do have a residential or an HOA management referral you'd like to bring in, Kara is a great person to talk to. You can also earn referrals from sales, commercial sales and leasing, or even possibly a shared commission. Ryan is a great point of contact if you have a commercial sales or leasing lead. Commercial property management, again, brings in a 20% of the monthly fee for the first year and 10% for following years. Rochelle is a great person to talk to there. You can also refer a friend or a family member to an out-of-state agent if they are moving out of state. The agent can typically ask for 20 to 30% of their commission as a referral. Typically 25% is what Amanda sees. And if you are interested in doing this, there's already an agreement form in the residential sales form. Amanda or Susan are great people to talk to about this as well. Don't forget you can get extra income just by recruiting other agents to PJ Morgan. You can get 5% of that agent's commission for their first 25 transactions. If you have an agent that you think would be a great fit for the company, Susan and Ryan would be the appropriate people to talk to. And lastly, you can get a referral fee depending on the deal for any business brokerage that you can bring into the company. Ryan and Bruce are good contacts if you have any leads on that. Here's a few free sources to generate income. Your social media will help you generate income if you have an active presence. Email marketing is a great way to generate income. Hosting open houses helps you meet new people and get your face out there. Offer to assist agents in the office when they are busy or out of town. Network with vendors to build relationships and generate referrals. And you can always wear company branded gear. Hopefully it'll spark a conversation about real estate. You never know when you could get a lead from that. It's just kind of a general business budget again that I put together. I've already showed you this slide, but I wanted to compare it. This is a format I enjoy using, but you could also use something just as simple as this, where it just breaks it down by your total income, total taxes, your business and personal expenses, and then you calculate your profit over to the side. Speaking of profit, once you've calculated all of your expenses and compared it to your income, does your profit fall in line with what you expected? And don't forget to keep your taxes in mind. That's a big part of your expenses. If it doesn't fall in line with what you're expecting, you can look at increasing your income if there are ways to do that. Can you decrease your expenses, or can you decrease your taxes? And your CPA would be a great person to help you answer that decrease your tax portion. And once you have profits, you need to decide what you want to do with them. You can save them, you can spend it, reinvest it into your business, or you can reinvest it into a different type of investment. Again, your CPA is a great person that can help you decide if investing is a smart idea for your company. Here are a few resources that we offer at PJ Morgan to help you. We have an amazing marketing team, so please contact Clinton and he can help you with all sorts of marketing things. I'm sure he's taught you about social media, and they can help you with postcards and flyers. And Kelsey is fantastic with graphics, and Clinton's doing videos and leading all kinds of classes. So they are a fantastic resource. Don't forget to use them. We also have a bus bench program. In case you weren't aware, you can have a bus bench, and the company actually pays for half of that cost. The other half is billed to you. You can always check out signs and lock boxes to save expense there. Another great resource is Dotloop, which we are just implementing, and Amanda is going to start training on that at the next sales meeting. If you're part of the mentor program, use your mentor's knowledge. They're going to be a great resource for helping you get your business up and going if you're new. And don't forget to build relationships inside the company. You never know when a relationship will generate a lead. Or you can always join the accountability committee. We meet on Tuesdays every other week. We have a $100 buy-in, so if you're really serious about meeting those goals, come join us and we'll see if you can keep your money by meeting all of your goals and accountability. A few other resources. Budgeting apps are fantastic. Once you have your budget set, I love mint.com. I actually used this personally for a long time. You can go in and set up your budgets for the month and for the entire year. And as you make purchases, it's going to either automatically put it into a category, or you can tell it what category to put it in. So you can see exactly in real time where you're spending your money and if you're staying in your budget. You Need a Budget, or YNBA, is another great source. They function a little different. Whenever your income is, you take each dollar of that income and you give it a job. So as opposed to budgeting for an entire month at a time, you're budgeting how you're using that income every time you get it. Wave Apps is another budgeting tool that you could use. And then there are a ton of financial planning templates available. You can find free ones out on the internet, or you can find really pretty fancy ones on Etsy if you really want something fancy. There's also a few property research apps that you can use. RPR and HomeSnap are great ones. and a mileage tracking app. Adam kind of talked about this earlier. There's one called Mile IQ, which is super helpful. And once you get in your car, it'll help track that. Amanda is a great resource on RPR, Home Snap, and Mile IQ. So if you have any questions about those apps, she's a wonderful person to talk to. And of course, your CPA is always going to be a very helpful resource, especially where your retirement or your taxes are involved. Does anybody else have any resources that they use that they would love to share with us? Or any apps that they find really helpful? All right, well, once you've gotten your budget all together, you just want to make sure that you check all your boxes. Have you created your entity? Do you have your business bank account? Have you established your goals for the year? Have you separated out your personal and business expenses? Don't forget to pay yourself. Create a marketing plan and calendar. Identify your income goals and have a plan for your profit. And a lot of these things can be revisited frequently throughout the year. You might have to make tweaks just depending on what's happening in the market, or maybe you're having a great time and now you need some additional marketing because you have the resources to do so. So make sure you're checking all of your boxes when you have your budget prepared. And then that's all I have. So please let me know if you have any questions. And a huge thank you to Amanda for helping me with a lot of these resources. All right, thanks everybody.
Thank you. Thanks for the good job today. There was lots of helpful stuff here.
Great, thank you.
Great job, Kira. Thank you.
Thank you.